Hello, Sean Eddings here. Welcome to another edition of the MicroCapClub Member Spotlight. In these interviews, we'll showcase many of the talented members of MicroCapClub. Today, we have James Emanuel, private investor. James, thanks for joining us today.
Hey, Sean. Thanks for having me.
So tell us about yourself and how you got to investing in microcaps.
Yeah, sure. So I've been in the finance and banking sector for about 27 years. I actually qualified as a lawyer, but decided not to practice. I like the excitement of the financial sector, and I come from a background of financial people. My father was a stockbroker. My brother's an actuary. And so it was kind of natural to move in that direction. And I've worked for some of the big tier one banks. I've worked for Deutsche Bank Asset and Wealth Management. I've worked for Citigroup. And most recently, I've been working at Nomura, the Japanese investment bank.
And specifically there, what have you been doing? What capacity?
Well, primarily on the trading side, in the front office. But my trading, as far as microcaps are concerned, is all personal. I run a private fund and invested in that fund alongside myself, our family and friends. I'm the managing partner, and so I make all of the investment decisions. And it's interesting, you know, people outside of the investing community often ask me, what hope do you have of outperforming professionals? And I think what a lot of people don't realize is that you don't have to outperform the professionals. It's actually not that difficult. Let me give you an example. The professionals are very constrained. So just imagine a fund manager with $2 billion of assets under management. Now he has to conform to a constitution, which is put out to the investors, and there's no flexibility there. So let's just assume the constitution says he has to invest in no more than 40 companies. Now, if he's got 2 billion assets under management, that means with 40 company limit, he's got an average investment of $50 million per company. Now, another clause in the constitution may say that he can only have a maximum of 5% ownership in any particular company. And that's because of onerous regulatory obligations that arise if you hold a bigger stake, and perhaps an avoidance of concentration risk. So think about what that means in context. If he has to invest on average 50 million per company, but he can only own 5% or less of any particular company, that means he can only look at companies with a market cap exceeding $1 billion. So, you know, to kind of sum it up, professional fund managers don't fish in shallow waters. They ignore the investment opportunities of small caps. So, you know, people like me, I'm not competing with the professionals. I'm capitalizing on the investment opportunities that they can't touch.
What would you say would be the challenges of investing in small cap, but maybe what would be the difference between, say, anything under the $500 million market cap, which would be the microcaps, and maybe the $1 billion market cap?
You know, the interesting thing about small companies is that they can grow more quickly. You know, just taking things to extremes. If you consider a company with one customer, all that company needs to do is find a new customer, and effectively they've doubled their top line. Now, if you're a Facebook and you've got 2 billion customers, it's not so easy to double. And so, you know, you can see in that context that the small caps, the small companies, as long as they're well managed, they can grow really rapidly, and they can generate some really high returns. But, you know, small caps don't come without challenges. And one of the key challenges that I see for small caps is what I classify as a circumstantial CEO. Now, what I mean by this is that the skill set to create a successful business and to raise capital through an IPO is rarely the same skill set required to drive a public company forward. So, you know, take an example, take a software developer. A software developer may write an app which goes viral, hugely successful, and he wants to build on that foundation by recruiting new developers to work alongside him and to build new apps. So he needs to raise money. And he sells off a part of his company through some kind of an IPO, and suddenly he finds himself as the CEO of a public company. Now, what does he know about the nuances of effectively allocating capital or making strategic commercial decisions in the boardroom of a public company? The truth is nothing. You and I would never jump behind the wheel of a car not having taken driving lessons, but many people jump behind the wheel of a public company equally ill-prepared. So that's one of the big challenges. And one way of dealing with that is for the founder to perhaps step aside and to bring in a seasoned CEO. Perhaps the founder could become chairman instead. But these things are never easy, particularly if the business was something that he himself built from nothing and has a major proportion of his personal wealth invested. It's not easy to put that much trust in a stranger. Interestingly, if you consider Larry Page and Sergey Brin, the founders of Google, they tried after their IPO, they tried to manage the company, but they realized that, their skill set wasn't well suited to business administration. And so in August 2015, they stepped aside and allowed Sundar Pichai to run the business. And since then, they've maintained their equity stake in the business, and the market cap has risen from 450 billion to about 2 trillion. So for them, it was a very good decision. And I think for most other small caps, it would possibly be a good decision to stand aside and to avoid that circumstantial CEO challenge. As an investor, obviously, it's difficult. But the best we can do is, if we find a great company with great potential and a CEO who isn't necessarily experienced, jump on the telephone, raise constructive challenge, and try and introduce new perspectives for that person to help guide them along the right path.
In your personal investing strategy, is that something you do? You're very close connected with the CEO and you're really helping them along?
I do my best to connect, it's part of my due diligence to connect with the CEO, sometimes with the CFO. I don't like speaking to investor relations people because typically they read off a script. There's a standard company line and they toe that line. And you never really get the answers you need. It's better to hear direct from the horse's mouth and to make challenges directly to the people who are in the boardroom making the key decisions, to understand why they've made those decisions, and perhaps introducing, as I say, new perspectives so that the next time they have to make those types of decisions, but perhaps they take a different path.
Just expand upon your investing strategy.
Yeah, so it's interesting. From my perspective, too many people get into investing for the wrong reason. They're driven by the money that they hope to make. But, in my mind, chasing wealth is completely wrong. It leads to poor decisions, and this is where people lose money. In my mind, making money isn't the objective. It's a consequence of doing things right. And, over the years I've been involved in investing, I'm a habitual learner. I'm always reading. That's books, it's biographies, it's shareholder letters, anything that I can find. I'm kind of passionate about business administration, which makes me sound a little bit geeky, but I think you need to understand the nuances of running a business to understand whether whether what you see is right or whether people are going down the wrong path. I relentlessly study what makes companies succeed, and what I've noticed is that patterns emerge. Which is really useful. As Mark Twain once said, history doesn't repeat, but it rhymes. And if you learn what ingredients make a great business, then you can immediately recognize new businesses that contain those key elements. In my view, most investors become obsessed with quantitative analysis. They plug numbers and assumptions into spreadsheets, but they miss the most important aspect, and that's the qualitative part. A lot of people just don't look at that. Don't get me wrong. I myself have a host of models and spreadsheets that I use, but they're never my starting point. I need to identify the qualitative aspects first, and make sure that those are present before I waste any time analyzing numbers. An investment thesis, in my mind, should first and foremost set out the qualitative part before diving into the numbers. But most don't even mention the pedigree of the CEO or the culture within the company. I mean, just consider, the dot-com boom. Every tech company was considered golden, and investing at that time was based on a narrative. So if you had .com after your company name, people wanted to put money into the company. Very few considered the ability of the CEO to actually deliver on what he was promising to deliver. It's back to front, upside down thinking, and that's why so many people lost money when the .com bubble burst. And I see parallels there in AI today. I think much the same is happening. So the message that I would stress is focus on what matters. And by analogy, you can have the best recipe for pancakes, but if your eggs are bad, you're never going to produce great pancakes, right? And it's the same with a business. In my mind, the key ingredients are people, culture, capital allocation, timescales, and aligned incentives. And I could talk for hours on all of this stuff, but we're limited for time today. So what I'd like to focus on is people, just to demonstrate what I mean. Good people don't pursue bad ideas. So if you invest in the right people, investors have less to worry about in relation to the ideas themselves. And this was something I actually picked up from reading the book written by Ed Catmull of Pixar, Creativity Inc. He said ideas come from people, therefore people are more important than the ideas. Getting them right is a necessary precursor to getting the ideas right. And giving a good idea to a mediocre team is like giving a bottle of champagne to a child. It won't understand what to do with it.
Right.
But if you give a mediocre idea to a brilliant team, they'll either fix it or throw it away and come up with something better. And when I read the book, The Creativity Inc., I read that paragraph, that quote, probably 3 or 4 times, and it really struck a chord with me. It really resonated with me. And what I'd like to do is kind of talk through some great examples to bring that to life. So I don't know whether you're familiar with Xerox PARC. PARC spelled P-A-R-C. Stands for. Okay. So for anybody listening to this that doesn't know Xerox PARC, PARC stands for the Palo Alto Research Center. It was established by the Xerox Corporation in 1970, and it was responsible for pioneering many groundbreaking computer technologies, including the graphical user interface, the computer mouse, Ethernet networking, laser printing, and the first computer, which was called the Alto. But the key here is that Xerox had all of the great ideas, and they actually generated these new technologies, but they failed to capitalize on many of the PARC's inventions commercially. That really is what Ed Catmull was talking about. But by contrast, Steve Jobs was inspired by the work being done at Xerox PARC. He saw the GUI that they'd produced, and that inspired him to develop the first commercial GUI at Apple for its Lisa computer back in the early 1980s. Until then, everything had always been command line DOS operating systems, and so the world really shifted there to graphical interfaces, which kind of moved us on. And it wasn't for several years later that Bill Gates came along and saw what Steve Jobs was doing at Apple and launched the Microsoft GUI, which was called Windows 1.0. That happened 5 years later, in fact, in 1985. And although we're supposed to be focused on microcaps today, and despite their size today, both Apple and Microsoft back then were effectively small caps. The Apple IPO happened in 1980 and raised just $100 million. And Microsoft didn't, in fact, IPO for another 6 years. 1986 was their IPO, at which time they had a market cap of $700 million. So back in 1980, they were only worth a fraction of that. But they kind of capitalized on these opportunities that Xerox passed by. So again, it isn't the ideas, it's the people. I find it really interesting because both Jobs and Gates diverged significantly in their commercialization approach. So Jobs was always focused on hardware sales. He wanted to make the computers back then. And he decided to keep the GUI operating system that he developed closed. It was only available on Apple products. In contrast, Bill Gates focused exclusively on software. And so he licensed Windows, making it accessible to anyone, opening the floodgates effectively for the widespread adoption of the Microsoft operating system. And so this is how Microsoft became the dominant player of operating systems. And just a few years later, 1994, it had 90% market share. The really interesting part here is that if Apple, the Apple GUI was actually considered a superior product, and it was first to market by 5 years. So if Steve Jobs had focused on software instead of hardware, Apple would have owned that market, and products like the Apple Mac, the iPhone, the iPad may never have been invented. Because he would have been very preoccupied with the software side of things. And in such a parallel universe, Microsoft probably would have failed because it was 5 years too late to the party. But in the end, the way things transpired, it didn't go that way. Xerox failed to commercialize on its GUI, but both Bill Gates and Steve Jobs, using that as a foundation, pushed in different directions. And now, we both know how successful their companies have become. And so, once again, it's more about the people than the idea. Don't take my word for it. Warren Buffett is quoted as saying the single most important decision for him in evaluating a business is the management. He looks for people with talent, with character, and with a high degree of integrity. And he says, if you have those three things, you've got a tremendous business. And these kind of lessons repeat time and time and time again. If you've ever read Made in America by Sam Walton, the brains behind Walmart, you know that his first store opened in Newport in Arkansas. And it was very, very successful. It was the most successful grocery store in the States by a real significant margin. But he made a significant error, which he admits in his book, which is that he didn't include in his lease of the building he was using a lease renewal clause. And so at the end of when the lease expired, his landlord, very greedy, saw how successful the business was. There was no obligation to renew the lease. And so he refused to renew the lease. And instead, he took over the operation of the store, which was already incredibly successful, already well known, and already had a client base. And he gave that store to his son. And Sam Walton obviously knocked down, had to start over. And he did. He went away and he set up other stores in other states and became successful. And it was some years later, it was about a decade later, that he came back to Newport, Arkansas, and he opened his 8th or 9th store. And, you know, Sam Walton took Walmart to be the biggest grocery store globally, most successfully. And his first store, which contained all of the key ingredients, because he'd created that, which was given to the son of the landlord as a going concern, came to absolutely nothing. So once again, it's not the idea, it's the person. And you know, this repeats again and again and again through history.
Topic, James, about the people, the repetition of culture and people being the most important component within business.
Yeah.
It sounds like many of these examples probably come from your book that you recently published called Fabric of Success. Can you just tell us briefly about that?
Yeah, absolutely. So I've actually got a copy here. I don't know if you can see that. Essentially, over the course of my career, 27 years, I've been reading, as I say, books, biographies, shareholder letters. I've been engaging with CEOs. And, you know, during that, I've accumulated so much knowledge, so much wisdom. And as I said at the beginning of our call, when I invest, I engage with CEOs and CFOs, and I introduce a constructive challenge to try and inform their decision making. And it's almost like deja vu. It's like Groundhog Day. It's the same challenges over and over and over. And the response is always quite positive. And, you know, the responses I get back are, I've never thought of it like that way, or I've never seen it with that perspective. And invariably, I find that companies make different decisions going forward. You know, I have companies, for instance, who very heavily reliant on dividends, who then subsequently, after we have a conversation, decide that they're going to slash the dividend and allocate their capital some other way. And so I thought, well, you know, if I'm introducing these challenges for CEOs and CFOs, and they're finding value in those challenges, then why don't I capture all of this value in a book? And the book is aimed principally at the CEOs of public companies, but it would also be very valuable to investors in public companies, because effectively what I do is I pull out the golden threads that run through the tapestry of every successful business. And, you know, these companies have so much in common that once you can identify them, you can spot them in new companies coming up. And, you know, the idea, as I've said, it's not about the idea. It's not about the business. It's about the person behind them. We're not trying to find the next Apple. We're trying to find the next Steve Jobs. I mean, if you think when Steve Jobs set up Apple, he was very brave. You know, he was young. He had no experience. And he decided that he would hand over the reins to someone else. And he brought in John Scully. John Scully was from Pepsi. He was one of the senior executives at PepsiCo. But of course, Pepsi is a commoditized soda drink. Right? It's so different. It's worlds apart from high tech, which was the Apple business. And so Jobs clashed with Scully after bringing him in and giving him control. And Scully ultimately pushed Jobs out of the company that Jobs had created. And, you know, Jobs was kind of out in the wilderness for a little while. But, you know, the key thing here is that Scully made all the wrong decisions. He didn't invest very much in R&D, and he tried to cut costs, and he brought in the wrong people. And by about 1997, which was, I think, 15 years or so after Jobs had been pushed out, the company apparently had 90 days of cash remaining. It was really on the rock. It was on the point of crashing. Scully was eventually pushed out. Jobs was brought back in, and the company went from near bankruptcy to the heights that we see today. And so, once again, we're not looking for the next Apple, we're looking for the next Steve Jobs. And so that's really what the book pulls out, these golden threads that run through the fabric of all of these really successful companies.
How long have you been a member in MicroCapClub for? Do you remember?
Been a member for a couple of years, I think.
And how do you like it so far? Are there any value adds that you've been able to draw from it?
MicroCapClub's fantastic. I mean, it's got a great body of members. The ideas that come out are wonderful. There's such a huge number of companies that can be invested in, and it's impossible for an individual like myself to analyze all of these companies and to turn over every rock, as Peter Lynch used to say. And so it's a great way to discover new opportunities. We work effectively as a collective for our combined benefit, sharing the workload together. I've often wondered, how we can take it to the next level. For instance, small caps, they don't have a huge market cap. That's why they're called small caps. And if we're all investing in a similar company because we can all see the value in that company, is there any room for us to collectively to become a little bit more activist? Maybe even as a group, as an MCC group, request a seat on the board if combined our shareholding is large enough. Just an idea, but something certainly to consider.
Again, James, it's wonderful chatting with you today. Where can people find more information about your book, and where could they also find how to connect with you? I'll share your MicroCapClub handle below, but if you have any of the other areas on the internet we can see at, that would be awesome.
The best way to contact me is through MicroCapClub. I've got a website, which is theinvestment.company. You can find me there. You can contact me via that. And I've also got a Substack, which is a Rock and Turner. I can provide you with the link after the call.
Appreciate it, James.
Okay, my pleasure. Thank you for having me.